One of the examples for managing the financial status, Lincoln Literacy Financial Class Money and Me spin-off program. Number 1. Collect receipt for all you purchased. Number 2. Keep a household account book. Number 3. Have multiple bank accounts. Capture your status. Keep your money safe. Have your money grow up. First of all, grasping how much you spent in the month is the most important. So collect a receipt for all you purchase by either paper receipt or electrical receipt. Keep a household account book. Recording the sector and the payment method also necessary. So you can easily analyze what kind of things you spend. Engels coefficient is a good key performance indicator for your future planning. Number 3. Have multiple accounts. Capture your status. There are 3 advantage points to have multiple accounts in your bank. Number 1. You can easily grasp how much you earned and how much you spent individually. Number 2. Your deposit in a saving account is some interest. Number 3. You need to transfer a certain amount every month from the saving account to other 2 accounts. It makes you always remember how much money you have. Use a saving account for all income. Use a checking account for all payments. Use an investment account for your future. Keep your money safe. Number 1. Always put the same amount in your checking account. It's gonna be a safety net in case you forget to transfer. Number 2. Transfer the exact amount from your saving account to your checking account every single time you receive a bill and wrote a check. It might be a hassle, but by this activity, your checking account visualizes outstanding checks, deposit in transit, and any withdrawals. Double-check the credit bill and the check records every month. The biggest advantage point is you can capture issue in case somebody has withdrawn your money by dishonest means. Now I show you the ropes making your money grow up. Transfer to save the same amount from your saving account to your investment account when you receive your wage. Invest in stocks or bonds to prepare against inflation. There are various ways to have money grow up, but let's focus the most popular and the most steady 3 ways. Stock market, government bonds, bank interest. Those are generally explained like this. High risk, high return. Low risk, low return. No risk, the lowest return. If you invest $100 to a stock market, you will expect a 20% return, but also might decrease the same way. If you buy $100 value government bonds, you will expect a 5% return, but also might decrease the same way. If you deposit $100 to a saving account, you will expect a 0.05% return and the amount is insured. That's why to deposit a bank is recognized no risk. But is that true? Think about it. What if you have $100 and you have 2 options? Number 1. Buy a Christmas tree now. Number 2. Deposit to your bank now and get the interest a year later. The national average interest rate for savings account is 0.05%. So if you keep $100 in your saving account, you will get 5 cent interest from bank and your balance is gonna be $100 and 5 cents a year later. Do you really think you made a profit? Jay Powell, chairman of FRB, has officially declared to aim 2% inflation per year at least until 2022. It means if a big Christmas tree costs $100 today, it's gonna cost $102 on the same day of next year. So you could buy it now. But what happened a year later? No, you cannot buy it anymore. This is inflation. Again, it means if a big Christmas tree costs $100 today, it's gonna cost $102 on the same day of next year. However, the interest is only 0.05% and too small against the inflation rate. And you cannot buy the same Christmas tree next year even though your balance would increase a bit. Now you see how inflation impacts your ordinary life. Let's go back to the previous question. Is really no risk that you just deposit your money in a bank and receive the interest? Is that true? The answer is no. You'd better figure in the inflation rate when you plan to grow your asset. $100 as of today is not the same value as $100 as of 10 years from now, especially current circumstances which are under struggling against the coronavirus disease. All country governments are issuing their currency more than usual to sustain their economies. It means that inflation is accelerating. In other words, the value of the currency has come going down. How can we avoid it? How can we have our money work? The answer is to learn an investment. The investment also has a risk. The most important thing is balance, the balance between risk and return. There are returns as face value and subtract the inflation rate. See, this is the reason why we need to learn investing and maintain the balance between risk and return, then getting profit in a safe manner. Thank you very much for watching.